If you're a videographer or you're a creator or a content agency, anywhere in the digital realm, this video is going to be really useful to you because it's going to be exactly what you should do as far as taxes, as far as structuring your business, how to pay yourself, how to take write-offs, so many things in between. We got a bunch of questions lined up, not only from questions that should be asked, but also questions from you guys as well. Dylan, why don't you tell them a little bit about yourself real quick? Dylan is my accountant, my bookkeeper, and he does everything for me. I hate doing taxes with a passion, and he takes care of that, so I appreciate you for that. Shout out Dylan. But tell them a little bit more about yourself and why they should listen to you.
Yes, sir. So we've been working with Presley and Cam for about over a year now. And why you should listen to me, we have a fractional CFO and accounting firm where we work with 35 clients currently on a retainer basis doing their CFO and accounting and tax stuff.
Awesome. So I guess with that being said, Ben, I'm going to ask for my phone back, and I'm going to kick off this first question. I feel like, okay, solid. This one, okay, I feel like this is like the kind of fun question that I feel like everyone has, and then we'll go right into serious ones right on top of this. But this is the first question. Can I write off my Lambo for marketing?
Yeah, everyone wants to write their car off, but the thing is unless you're making a disgusting amount of money, actually buying a vehicle and writing the whole thing off in the same year it was purchased probably isn't the most advantageous thing you could do from a tax perspective. But could you do it? In theory, yes.
Okay, cool. And then let's go a little bit more in depth on that.
Yeah, so for the vehicle, for marketing specifically, or just for the vehicle?
Maybe talk about both.
Yeah, so for a vehicle, there is bonus depreciation. It's decreasing every year. But you can, if it's over 6,000 pounds, you can buy it and write off a good chunk of it in the year that it's purchased. But the problem is there's a lot of reasons why you probably shouldn't do that, because the goal with tax planning is for you to pay the least amount of tax over your lifetime, not necessarily the least amount of tax this year. So most people, their income tends to increase over time, especially if you're younger, because your skills and your earning capacity is increasing over time. So for you to buy a very expensive car and then try to write off a big chunk of it in the first year, if you make more money a couple of years, over the next few years, you're actually not paying the least amount of tax over that timeline. Another piece of it that people don't think about is like if you buy a $100,000 car and depreciate it to where the accounting value is $0, and then 2 years later you sell that vehicle for $80,000, that's essentially an $80,000 gain that you're going to owe tax on. So for most people out there, if you have a vehicle that you use for business, it's best to maybe claim that vehicle for like 50% business use and then just track the mileage and write off the mileage at the end of the year. That's really the best way for most people.
Awesome. So that's kind of like the out there question that I feel like everyone wants to know. At least I want to know. Now let's go to some of the more basic, like beginner-friendly questions. The first one is, what business structure would be the most advantageous for video production companies, or for a video production company, sole proprietor, partnership, LLC, corporation, etc.?
Yeah, that's a great question. So a lot of people want to know when they actually need to get an LLC. If you're a freelance video editor, most of the time, just a single member LLC is going to be great. I don't think you need to get one right off the bat. Like if you have 0 clients and you're making 0 money and this is just something you want to try out, you don't need to do it right off the bat. I would wait until you have like one consistent client that's paying you, maybe it's $1,000 a month. Once you're at that point, the concept is proven that you can do that thing and people will pay you for it. Then you go open that single member LLC. I recommend for most people just opening it in the state you live in. A lot of people are like, do I open it in Delaware or Wyoming? From a tax perspective, you owe the tax in the state that it's earned. So it really doesn't matter. You should just make the LLC in the state that you live in 99% of the time. Most of the reason people will put it in a different state is actually more for remaining anonymous than actually the tax advantages.
Gotcha. I would actually advise you to not open a business until you sign your first client, until you have money coming in, because then you have an expense of actually starting the business and there's no income coming into it.
Yep, I agree.
Cool. So that's number one. Number two, what are the tax implications of each business structure and how will they impact my income, payroll taxes, and overall tax liability?
Across the different entity structures?
Yeah. So sole proprietorship, which is not really business, partnership, LLC, and corporation.
Yeah. So for each of those entities, right, there's like tax considerations and then there's legal considerations, right? So like most of those entities you rattled off are what's called a pass-through entity. So they're not actually taxed at the entity level. They're actually going to flow through and get recognized on your personal return. So like the difference for a lot of those kind of comes as far as liability. So it's a sole proprietorship. You're personally taking on all of the liability, and it's also going to pass through to you. Whereas a single member LLC, the income and expenses are going to pass through to you, but there's that extra layer of liability protection because of the LLC. An S Corp is also a pass-through entity, a partnership, multi-member LLC. Those are all pass-through entities. So those entities, 99% of the time are not paying tax at the entity level. It's all going to flow through to your personal tax return. For a single member LLC, that actually goes on your personal tax return. If you have a multi-member LLC, a partnership, an S Corp, a C Corp, those are separate tax returns like for those entities. As far as a C Corp, that's one that is not a pass-through entity. So what happens there is the entity pays tax, and then any dividends that are paid out to the shareholders, you also pay tax personally on those dividends. So that's where you get the double taxation. For most people, like if you're a freelance editor, you got no business being a C Corp. Like the route that'll happen most often is you'll be a single member LLC. And then as you start making money, you get to the point where you're profiting $80,000, $90,000, $100,000 a year, then you're probably going to make that transition into an S Corp.
So at what level should you open up an LLC? First client or revenue amount?
Just when you have some consistent money coming in through the business. Like if you land something where someone's paying you $1,000, $2,000 a month, you're doing consistent work for them, I'd say go ahead and open it.
And you'd say start with an LLC?
Yeah, single member LLC is going to be the way to go 99% of the time, especially if you're a freelance video editor. If you have a partner, then it's probably multi-member LLC. But if you're just starting, you should almost never elect as an S Corp right away because it's actually less advantageous if you do that before you're profiting, $70,000, $80,000, $90,000 a year. That's when an S Corp starts to make sense.
How does the tax structure differ from an LLC to an S Corp? As far as I know we have an S Corp and we're able to pay ourselves a fair salary as well as take distribution. Yeah.
Yeah. So there's a ton of content out there about S Corp. Some of it's really good. Some of it's a little misleading. The main tax advantage of an S Corp is mitigating some of the self-employment tax, which is also like Social Security, Medicare. It's kind of the same thing. If you hear self-employment tax or Social Security, Medicare tax, it's the same thing. So if you're a normal employee, right, you pay 7.2 something percent, and then your employer matches the other 7%. So it's like 15.2, 15.3%, somewhere right there, as far as like the Medicare and Social Security tax. But when you're self-employed, like a single member LLC or sole proprietor, any of those things, you're responsible for paying that entire 15% because there's not somebody matching it for you, right? So the idea with an S Corp is you pay yourself a fair salary, and your salary amount you owe that 15% on, but then the distributions you take, you're not getting hit on that 15%. So you can save a lot of taxes on the self-employment tax. The disadvantages with the S Corp is it's a little more rigid. So S Corps are great like for service businesses, like where you don't have a ton of equipment or big, large assets like your guys' business, right? That's where S Corps can really be advantageous. It also depends on your state a little bit. Like New York and Tennessee, for example, aren't as great for S Corps. So it can kind of depend on where you live a little bit, but once you're netting 90,000, 100,000, 130,000 a year, the S Corp can save you multiple thousands of dollars a year.
Gotcha. Okay, so start as a sole proprietor first until you start making money, and then once you start making money, $1,000, $2,000, $3,000 a month, open a single member LLC. Unless you have a partner, open a partnership LLC, and then once you get to like 100K a year, then move to an S Corp.
Yep, I would say once you're netting 75,000-ish per year, and every accountant will tell you something different. Some people will say 50,000, 60,000. I think more 70, 80 personally is what I'd say is when it's probably worth a discussion with an accountant to see if it makes sense for you.
Gotcha. Awesome. And then
don't make an S selection without talking to an accountant. Like that's definitely something you want to have a conversation with a professional about beforehand.
There's one right there. Found one. Okay, so question 3 is what deductible business expense can I claim as a video production company? Equipment, software, travel, insurance, etc.
Yeah, so the tax code says you can essentially deduct or write off. That means the same thing pretty much. Anything that's ordinary and necessary in your pursuit of making income. So for you guys, video editors, typically that's going to be some software. You're going to have editing software, maybe website hosting fees, maybe a CRM, that sort of stuff. Your camera equipment, definitely. You guys are like a higher end agency. You guys like to fly out and shoot in person with people. So those flights, hotel rooms, the meals while you're traveling, that's all deductible. So really just anything ordinary necessary in terms of running your business. Now, where you need to be careful as someone in the video business is you will see a lot of people online telling you anything that you buy, as long as you put it in a video, you can write off, which is very misleading. That's not really how it works. And just one good example would be clothing, right? There's a lot of people that try to write off clothing, especially people that are content creators. They're like, yeah, I got my Rolex and my expensive shirt. Like, let me write it all off because it's in a video. And it's just not how it works. Like, there's tons of court cases. Like,
explain to me what you were.
That it doesn't. That's inherently personal. Clothing is an inherently personal item. You're definitely not going to win that battle with an auditor if you try to write off your shirts, even if you wear them in your videos.
So tell me what you told me at lunch, where I didn't actually know this. There might not be something in the code of law for that specifically, like, oh, writing off a Rolex or writing off clothing or your car to some degree. But there have been court cases around that, and they default to, say like so-and-so, dealt with this and they had a court case against them and the IRS or whatever won, then they default to that court case being won and they place that on you if you do the same exact thing.
Essentially, right? So like the tax code is a ton of gray area.
Yeah.
Like you can write off what's ordinary and necessary. That's
up
super
to you,
vague.
your call.
You know what I mean? Super vague. So when these super specific, instances come up and they go to tax court, and sometimes they go to tax court over and over again. And that's the thing, like with clothing, where there's multiple court cases of them ruling like, hey, clothing is inherently personal. It's not a tax deduction for your business. If you are trying to write that off and you end up getting audited, the odds of you winning that it's zero. Like, you're not going to win that, for example. So yeah, like tax code, it does tell us a lot of stuff. A lot of it's gray area. But what a lot of the influencers that like to talk about tax stuff, they're not going back and reading court cases.
Yeah.
You know what I mean? It's like sometimes they'll be like, hey, you could set it up this way and write this thing off. And it's like, well, maybe if you just look at the tax code, you could maybe make an argument. But if there's 10 court cases saying, no, you can't, then you probably can't.
Yeah. So, and this is actually something that we covered at lunch as well, because Ben and I, on day 2 of our 0 to 10K a month agency series, we walked into a clothing store and I was like, oh, you know what? It'd be good if I buy this shirt for myself and a hat for Ben, so that when we walk back in and we have a conversation with the decision maker, we can, obviously write this off because it's part of making this video and we need it or to do whatever we want to do with this video. And then he's like, well, here's the thing. See how Ben's wearing the hat right now and it's not part of that video? There's your argument.
Exactly. Yeah. And that's the thing for a lot of business owners. Like, you could probably make a logical argument like, yeah, this was for business, but everything's a write-off until it's not. Everything's a write-off until you're sitting down with an auditor, and that's just a battle you're probably not going to win with an auditor. For sure.
So the super safe stuff, travel for clients or for your business, food, whenever is, correct me if I'm wrong, from the moment I get to the airport to travel to a client shoot till the moment I land back.
Correct.
And like come back to my apartment. That is all included with the trip, the Uber ride to the airport, the plane ride itself, food in the airport, food and lodging where I am at, whatever expenses that I incur while I'm on the business trip that apply to the business trip.
Correct.
And then everything on the way back.
Yeah, and one thing too I would say that kind of falls into that is like if you need access to a certain location for a shoot, I would probably say, yeah, that's a write-off. Like if you're, going to a shooting range to make very specific content there, I think that's a better argument to be written off in your business versus like, hey, I bought this shirt for this video.
For sure.
Right? Or like you guys rent studios a lot to record videos with people. Like absolutely. Like studio rentals, equipment rentals, all that stuff is definitely deductible and should be put on your business card as an editor.
100%. And we make sure we do that.
Absolutely you do.
He's like, I go through it all. You sure do. Okay, so also, if you buy coaching or consulting for business, that is also a write-off.
That's a great one. That's actually one of my favorite ones. Like, what better write-off to get than purchasing something that's going to increase, your earning capacity and make you a better business owner and a better person.
Paying you is a write-off, right?
Correct. Yeah. And that's missed a lot, actually. Like paying, for your tax return to be filed, paying for the bookkeeping, paying for CFO, consulting, any of that stuff, definitely ordinary necessary. Lawyer fees.
Or if you buy a videography course or sound design course or
any course, really.
You buy LUTs and assets as a videographer or some sort of training, all write off.
Yep. And even like maybe there's a conference a conference for video editors across the country, you flying
traveling
out
there,
to purchase the ticket to go to the conference, the lodging, that's definitely all a write-off.
Now, for those, I've crazy enough, I've met some people that think a write-off just means that like it just you swipe your card and somehow like it just doesn't get deducted from your bank account. Like it's just you got a free purchase. Explain what a write-off is.
Yeah, so write-offs or tax deductions and tax credits get confused a lot. So tax deductions reduce your taxable income. It's not a dollar for dollar refund, right? A tax credit is often dollar for dollar. A tax deduction is reducing your taxable income. So for example, if you were getting taxed at a 30% tax rate and you spent $100 on a video course, your actual tax savings is $30 because the taxes on $100 of income would be $30. Does that kind of make sense?
So okay, let me make like a large example, right? So say I make $100,000 in a year, $130,000 in a year, and I go and buy a sweet red camera setup with some fire lenses, and it costs $30,000. And that's obviously a business write-off because I have a videography business. Now, would I be taxed at $100K or would I be taxed at $130K, and then that's like a tax credit?
Yeah, so how it works is like you have your revenue, like the total amount of cash you brought in,
$130K.
so $130,000, and then you have your expenses, right? So if you had $30,000 of equipment rental and whatever else, that's reducing your taxable income from $130,000 to $100,000. And that's where the savings comes.
Gotcha. And I would only be taxed on $100,000.
Correct.
I still spent the money that I made.
Correct. That money is gone.
It's gone.
You should. I always tell people you should, because there's a lot of people that get obsessed with writing stuff off and trying to.
I am one of those people. I am people.
Like, you shouldn't purchase something just for the sake of writing it off. It should be something that's actually advancing your ability to make money, or something the business actually needs and is going to use.
Yeah.
But just buying something just for the sake of buying something, like you're spending $1 to save 30 cents.
Yeah.
That's essentially what you're doing.
I like saving 30 cents, not giving it to Uncle Sam.
Yeah. I mean, if you need it for the business, absolutely. Why not, right?
Yeah. He's right, though. Listen to him. He's smarter and with that. How should I track and document my business expenses to ensure I maximize my deductions?
Okay, so the most baseline level of this is once you have your single member LLC or whatever entity, you need to open up separate business bank accounts. Like it needs to be done immediately. Like once you have your LLC and all that paperwork, next day you go to your local credit union or bank or Mercury or whatever. A lot of online guys like to use Mercury, and you go open that business bank account.
And you're using that tax ID or EIN number from that business to open that. So
Correct.
The business that you're opening is a separate entity from you. So you have your own bank account that's usually opened underneath your social security number. And then when you start a business, essentially it has its own social security number, EIN number, and you're opening the business bank account under that entity and that number.
Yep, that's correct. And it's really up to you. I like local credit union. If you like a fully online thing, Mercury's great.
I've had a great
too.
experience with Mercury.
Yeah, a ton of people love Mercury, so that's great. You just want to have everything separate. And that helps you from a liability perspective as well as a tax perspective, because when things are separate like that, you're able to make sure that business expenses aren't falling through the cracks, right? Because if you're putting a bunch of business expenses on your personal cards and you're not tracking it and then you're not telling your accountant about it, those are purchases that would reduce your taxable income that are never going to actually make it on your tax return because they're lost in your personal accounts, right? So you get those business accounts, you get all of your income and all of your business-related expenses on those accounts. That way it can actually, be tracked and put onto your tax return come tax time.
For sure. So we have two different business accounts that we have, and then I have my own personal account. So any business expenses related to those two businesses come out of those accounts so that he knows when he's going through, all these are business expenses. We've maybe had a couple things that weren't, that we might have accidentally spent on those cards
it happens,
or something.
But for the most part, you really want to keep it as separate as possible. Even if you're at a point where you can't afford a bookkeeper or a tax person,
still keep
you
it separate.
Still should have it super separate, because then
personal business.
Yeah, because then when you do go see a tax person, if it's separated, it's easier for a tax person to be like, oh, all of the business transactions are right here. I can put this all in Excel. I can wheel and deal, use some pivot tables, a bunch of nerdy stuff, and make, an income statement and a balance sheet out of this for a tax return, right? But if you have stuff super commingled, it is way harder for a tax professional to go in there.
Filter all of it. I did that my first year.
And they're going to charge you a shit ton of money because it takes a lot of time
to go fix it. So just do it right the first time. Yeah, keep everything separate if you can. Personal spending, if you're going to get a coffee for yourself, if you're going to buy groceries, if you're paying rent, and then have your business expenses in another account, just keep them as separate as possible. Makes it way easier when you hand it off to someone like this at the end of the year or end of the quarter, whatever.
Absolutely. And then the next step up from that, when you can afford a bookkeeper, do it. When you can afford, a plug-in finance team, which is kind of what we are, do it.
Yeah. Explain that a little bit, because you're a bookkeeper for us. Not only do you help us file our taxes for our business, but then you bookkeep. Explain that a little bit.
So our firm specifically is a little more full service. It's more of like a fractional accounting and CFO department that we plug into your business versus just a bookkeeper or just a tax person. So, for Cam and Presley, we're doing all of the books. We're running payroll for them. We're filing their tax return, quarterly tax calls, CFO reports, Slack channel. They have the ability to make a call with us anytime. That's, a higher level version of the service. Maybe when you're first starting out, maybe you're making $3K, $5K a month. Maybe what it looks like at first is you're paying someone $200 or $300 a month to do the bookkeeping and visiting an end of year accountant. And that's great for that level. And then once you start getting to the point where you're making $20, $30, $40, $50,000 a month, that solution becomes a little too reactive, in my opinion. Because if you're only speaking with your tax person once per year, that's a very reactive solution. In my opinion, most of the time you're not going to be put in the best tax position possible, versus if you had someone that was doing all of it with you, like we do. I do your books, or my business does all of your books all year long. Mm-hmm. We know exactly what's going on. There's no surprises when we go file your taxes.
He knows more than I do.
This is true.
Very true. And I'm okay with that. I trust him.
Yeah, and it allows him to double down on what he's great at, which is making awesome content for you guys, right? So he's doubling down on what he's great at, and we're able to free
paying an expert to do what he's good at.
Yeah, and he's freeing up that mental real estate, and he can just double down on himself. And since we started working together, you make a ton more money than you did when we first started working together.
Yeah, and we save more money too.
Exactly. Triple win.
Which is good. All right, on to the next. What are the tax implications of hiring independent contractors versus employees for my video projects?
Great question. So a lot of people think that they get to choose if somebody is a contractor or like a W-2 employee. So employee, W-2, contractor, 1099. A lot of business owners think that they get to choose which one. And there is some business models specifically where, it's kind of a gray area which one they could be. But for the most part, it's the nature of the relationship that decides that. So if you have a W-2 employee, usually the employer is dictating the hours that are worked, how and when the work is performed. They're providing the equipment for the work to be performed. They're matching the self-employment taxes or the Social Security, Medicare. Each party's paying 7%. All of that stuff, to where with a 1099 contractor, the contractor decides when and how the work is performed. They're using their own tools and equipment to do the work. They're responsible for the entire 15.2% of the self-employment taxes. So that's really the difference. From a pure tax perspective, it's more advantageous to be paying contractors as a business owner because you're not having to match that self-employment tax or that Social Security, Medicare tax. From the other side, it's you would say it's more advantageous to be W-2 because it's matching the 7%. But as a W-2, you also don't get access to the write-offs. So from a business owner perspective, for video editing specifically, you're probably good with like contractors 95% of the time until you start getting really big like these guys. But as you're making your way 10, 20, 30K a month, you're really probably good with editors. I mean, video editing is, a lot of people have that skill.
And a lot of it's project to project.
And a lot of it's project based too, yeah. So you can really get away with a lot with contractors in this industry specifically, for sure.
100%. I would say in the majority of cases, if you're a videographer, you should probably go and be a contractor when you're working with other businesses, and they should pay you as a contractor, which is 1099, which means you're invoicing them. They're not, paying self-employment tax or whatever. And then when you're hiring editors or maybe subcontracting videographers, do that as contract. We have a couple employees, and then we have a couple contractors as well. It just, again, depends on what that relationship looks like.
Yeah, 100%. So a first hire maybe for a video agency, as you start getting into that 30, 40, 50K a month, a lot of people, it's like a creative director, like someone in-house creative director. Maybe it's like a senior editor that's reviewing the contractor editor's work, things like that.
Do we have Will as a contractor or as an employee?
Just made him an employee.
Okay, so we brought on a senior editor for our agency, and shout out, Will. You're the GOAT. You're a great editor.
Shouts out.
And so he's an employee because he's like senior editor. His role is way more defined and hourly based and much more salary type work. Whereas we have other editors that he's like managing that are all contractors because they're like project to project, where Will is like every month, he has expectations he's supposed to hit, et cetera, et cetera.
Yeah, and typically when you're a W-2 employee, you're exclusively working for that person.
Correct.
Whereas with a contractor, you're probably working with maybe a few different clients. You're not exclusively bound to, one business.
100%. So Will, our senior editor, is exclusively working for us. Our other editors that work kind of under him and he manages, they do some work for us. I'm sure they do some work for other people as well. So they are contracting. We pay them per project, not per hour or, per amount of time.
Yep, exactly.
What records and documentation do I need to maintain for tax purposes, and how long should I keep them?
Yeah, so there's a few layers of documentation if you're doing things the right way. And I think what's important for people to consider is, there's a lot of people that are like, well, how will the IRS know that it wasn't for business? And what you need to realize is, in the case of an audit, it's not the IRS's burden to prove that it was for business or wasn't for business. It's your burden to prove that it was for business. So if you can't prove that it was for business, then it's automatically not for business, essentially. So there's a few different layers of documentation. So naturally, when you're making transactions out of your business bank account, those transactions are going to go on your bank statements, right? Another layer would be if you have an accounting software and an accountant, doing the bookkeeping. A lot of those softwares, there's a section where you can put down like what was purchased, right? You can write a detail. So you have the bank statement, and then you have the accounting transaction in the bookkeeping software that's saying who you bought it from, the transaction category, and then why it was purchased and how it's related to business. And then the next level beyond that would be keeping the receipts.
I don't keep receipts. Is that bad? Paper receipts. I don't like touching receipt paper.
Yeah, you don't have to keep it physically. You can just take a picture of it. So like if we want to be super, super best practice, like a business meal, on the receipt, you would write down who you had the meal with and what was discussed as business, and you would take a picture of it. That would technically be best practice. And for some people, it's business to business. Like some businesses will only keep receipts if it's over $100 transaction, for example, or over a $75 transaction. And then if it's under that, then they're not really worrying about it.
Gotcha. Okay. Do you think I should take pictures of my receipts?
I think it's best practice. Do I think it's going to murder you if you don't? Probably not. Especially where you live with your business partner. Like any meal with your business partner is a business meal inherently, right?
Yeah.
So that's pretty easy to prove. Yeah, but if we're being best practice, you would want probably another layer for the meals. Yeah.
Gotcha.
Yeah.
Okay.
Or any big purchases, you buy, a camera. It's probably good to keep that receipt or take a picture of that receipt because, there's probably a lot of people that would try to argue, hey, you could use camera personally, right? So just the more layers of documentation you have, the more protected you are in the off chance you do get audited.
Gotcha. Okay.
And for context, the average is most people get audited at least once in their life. And if you're on the unlucky side of that, you might be 3 to 5 times. And there's some people that never get audited. And the other thing I want to say is a lot of people think that if you get audited, it means your accountant did a poor job. That's not always the case. Sometimes, you just get picked. And that's just what it is, right?
I feel like I'm up next.
No, you're lucky, bro. God's favorite. No audits.
This is wood. There's wood under there for sure. Down there somewhere. How can I structure my compensation as the business owner to minimize my personal tax liability?
Yeah, it's tough because, like I said, most of those entity structures are pass-through entities. So whatever the net income is for your business in any of those entities, it's going to flow right to your personal, and you're going to pay personal tax rates on it. So the only way to reduce that is to, have a bunch of expenses to where it nets out to zero. With an S corp, like we talked about, you can pay yourself a reasonable salary and take distributions. That mitigates the self-employment tax for whatever the distribution is that you take, which at certain levels can, be, $5,000 to $15,000 in savings, which is pretty solid. But, if you're making good money, the reality is you're going to pay some tax. It's just unless you're heavily investing in short-term rental real estate or you have real estate professional status, those are that's kind of in the weeds a little bit, but those are the two main ways you can really consistently get it really low. Other than that, if you're crushing it, you're going to pay some tax.
For sure.
And I think what's important too is you have to understand that your tax planning should go hand in hand with what you're trying to do outside of taxes, right? If you're trying to purchase a house in the next year or two, but you're just obsessed with paying zero tax and you're obsessed with writing everything off. And then on your tax returns, it shows zero income. And then you say, hey, I want a $500,000 loan to buy this house. They're going to tell you screw off. They're going to say you don't make any money. I'm not going to. Why would we loan you money? You don't make any money.
Because your business makes the money and you don't.
Yeah, well,
or it doesn't even show a profit.
Yeah, it just shows. Yeah, you make zero money. Your business makes $100,000. How can we expect you to make this mortgage payment? So, it has to be with your goals. A good phrase is that I've heard from different tax professionals is paying your taxes is purchasing your borrowing power. So if you know you want to make a big investment or take out a big loan or purchase a house, it's worth it to pay a little bit more of taxes maybe for a few years. And there's that fine line, right? Like you shouldn't be overpaying, but paying what you need to so that you qualify so you can hit your other goals in life isn't a bad thing in my opinion.
Gotcha. What are the deadlines and filing requirements for annual business tax returns and personal?
Yeah, so if you have a personal tax return, so if you are a sole proprietor or it's just a W-2, you don't own a business, or a single member LLC, the filing date for that is April 15th. That's also when the tax is due. So some people think, I'll just extend, which means, you don't have to file till October 15th. But the tax you owe is still due April 15th. So just because you extend it doesn't mean you don't have to make an estimated payment or pay what you think is due, because if you don't, you're going to owe penalties for all those months that you're not filing it. If you have a partnership, multi-member LLC, S Corp, C Corp, that tax return is due March 15th.
Gotcha. How can I incorporate tax planning into my overall business strategy to maximize profitability?
Yeah, so it's kind of tough, right? Because like minimizing tax liability and increasing profitability are kind of enemies of each other, right? If you have a ton of profit, you're going to have tax on it. So I would just say getting with a tax professional that's going to meet with you more than once a year so that it's proactive, right? When you file in April, that shouldn't be the time that you're learning how much you owe. Like you should know how much you're going to owe that year prior because you guys have been planning it out throughout the year, right? So getting with someone that's doing it proactively. And then also you should be tax planning in line with your personal goals, kind of like what we were talking about earlier. Like what are we trying to do within the next 2 to 5 years? Are we trying to buy a house? Are we trying to take out a huge loan? Are we trying to exit, right? There's a lot of people that want to sell their business, but if you show zero profit on your tax returns 2, 3, 4, 5 years in a row,
no one wants to see that.
No one wants to buy that shit.
Yeah. I wouldn't want to buy it.
Exactly. So it kind of depends with what you're trying to do. Now, if you're solo freelance video editor and you might want to minimize your taxes best you can and take advantage of every write-off you can and, not live in that gray area, but everything that's ordinary and necessary that you genuinely need to use, you absolutely should take advantage of it.
Awesome. And the last question is from Mason, actual question. He said, who's your tax guy and can he be my tax guy? That's my tax guy right there, and he can definitely be your tax guy. Shout out, Dylan. Thank you for taking the time, flying down here and making this happen. He flew down here at like 12:30, and he's got to fly out at 7:30, so he just came for this podcast, this video.
Day trip, baby.
Yeah, little day trip. He showed up. I'm like, oh, so you didn't even bring your bags? He's like, no. Day trip, had headphones around his neck, and that was it. And I was like, nice.
Yeah,
that's
thanks
solid.
for having me, dude. It's been way fun. Hopefully this was helpful, and if you need help with this type of stuff, hit me up.
Yeah, hit the link below. Even if you're like under 20K a month, I would highly recommend going to him for even just a little consulting call, get you on the right path, set you straight. And then if you're over 20K, I would highly recommend working with him as a fractional tax
accountant, CFO, accountant,
100%.
tax guy.
He takes care of all of it. You can go focus on revenue generating activities and would be fantastic. Also, there's a Gamma doc below, how me and my business partner scaled our agency from 0 to 100K a month. Go check that out as well. That's all I got. Dylan, thanks again, and we'll catch you guys tomorrow.
Cool. Thanks for having me.